Hi, this is Dr. Ken Morlino, and the purpose of this short video is to illustrate some of the basic concepts from Chapter 1 and 2, and to look at specific figures presented in those chapters as a way of demonstrating how you can glean information from them. As you know, the main purpose of this course is to provide you a foundation in financial accounting, and more specifically to provide you an opportunity to interpret information from the financial statements, balance sheets, statement of stockholders' equity, income statement, and statements of cash flows. So if we just start by a few statement basics. Uh, the balance sheet shows the assets, liabilities, and stockholders' equity of the firm. Now, one of the first things that you will need to do as new accounting students is start to get a firm grasp of what these terms mean. If we don't understand what assets, liabilities, and equity means, we can sort of become lost quite easily as we get into the minutia of a balance sheet. Same goes for the other three statements as well. So try to increase your comfort with these terms through a careful reading of the text. Notice a couple things about the balance sheet. First, within the balance sheet is one of the four statements, the statement of stockholders' equity. So the balance sheet actually is two of the four statements. That accounts in balance sheets, so asset, liability, and equity accounts, are perpetual, which means that the ending values of those accounts at the end of one period becomes the beginning value of those accounts in the next period. Finally, income statement shows revenues, expenses, and income. And so income is the difference between revenues less expenses. And the income statement shows revenue and expenses and incomes over a particular period of time, say for 1 year. And these accounts have a beginning and closing amounts, which basically means that at the beginning of a new period, the firm would have zero revenue and zero income, which means that the amount was closed from the prior period. Also, the statement of cash flows and shows the sources and uses of cash over a period of time. And finally, a couple of things to notice. You will often see in statements the terms dollar millions or dollar thousands or a $000 and various values. So what that represents is if we see the number 1, 2, 3, 4, and it's in dollar millions, that actually represents $1,234,000,000. And similarly, if we see the value 1, 2, 3, 4, and it's dollar thousands, that value is actually $1,234,000. So it's a means of eliminating many of these zeros and condensing some of the information that would be shown in any of the statements. This particular image, Exhibit 1.2 from your text, is illustrative because it represents the overall business cycle. And the three activities that are shown and are specific to the statement of cash flows. Operating activities, which really represents monies generated by the sale of a company's products or services. So anything related to a company's sale of products or delivery of services is an operating activity. Financing activities represents where the money to purchase the assets and the cash to purchase those assets to support the operations, where does that money come from? And finally, investing activities. Monies raised through financing and invested back into the business are investing activities. And so finally, notice that these three activities correspond to how the statement of cash flow is organized. The statement of cash flow checks cash inflows and outflows through operations, investing, and financing. Planning is ongoing, and we have forces outside of the business that impact any one particular business, such as the economy, regulations, and certainly customer preferences and competition. All impact the planning of any one particular business. So this particular slide shows that there's two sources of financing for the firm. Creditor financing, which is monies borrowed, and owner financing, which is monies donated into the company from owners. And if we tie that together with the basic accounting equation, assets, liabilities, and equity, we see how this comes together. So monies generated through either borrowing from creditors, which is an obligation that the company must repay in the future. That's one source of money that is used to purchase assets, or money that is that is provided by owners, and therefore owners take the risk of recovery of their investment uh, in the company. So we see that each type of financing, whether it's from liabilities, obligations that must be repaid, or owner financing in the form of equity, is used to purchase assets or economic resources of value to the firm, and these assets are then used to build products, provide services which generate revenue, and revenue incurs expenses. As long as revenue exceeds expenses, there is income that is returned back to the owners either as profit or reinvested back into the business. Okay, so let's take a look at one of the specific figures from your text. Exhibit 1.6 in Chapter 1, which shows the balance sheet for Nike. Notice that it's as of May 31st, 2009, so it reports the amount at that closing date. Also notice that the information is in dollar millions, which means that for all of these values shown, we are actually going to add 6 zeros. So for example, cash is not $2,291, but instead is actually $2,291,000,000 since we are adding 6 zeros. Notice the two types of financing. We have creditor financing in the form of liabilities, which are legal obligations to repay, and we have the sources of owner financing through contributed capital, retained earnings, and stockholders' equity. These terms will increase their meaning to you as you progress through the next few chapters and work on understanding and a careful reading of the vocabulary. Finally, we recognize that this is an extremely condensed form of the full balance sheet that would be shown for Nike. It is condensed for the purposes of illustrating these basic concepts. And so what we will do is now look at a much larger balance sheet, one that is a little bit more accurate to what would be presented in the full annual report of a corporation. Okay, here we jump up to a figure from the beginning of Chapter 2, Exhibit 2.1, which is a balance sheet for Walgreen. Okay, and it shows, this particular balance sheet shows two columns of values. The ending values as of August 31st, 2008, the ending values as of August 31st, 2009. So one thing that you should start to recognize is these particular dates are very important pieces of information and doing your analysis, and certainly in terms of solving your homework. So now we see still assets, liabilities, and equity, but now these categories are now broken out into a series of sub-accounts. So we have a cash account, short-term investment account, accounts receivable, inventories, and other current assets. And then we have subtotals of, say, total current assets. We have this category called non-current assets, also more often named as long-term assets. So the word non-current is also synonymous with long-term. And so those are assets that have sort of a shelf life or extended economic value of greater than 1 year. So current assets and liabilities are assets or liabilities that are either used or paid within 1 year. And then the long-term assets or long-term liabilities are assets or obligations, liabilities that extend beyond 1 year. So as you progress into Chapter 2 and you're exposed to a lot of different types of accounts, your charge, so to speak, is to really start to understand what these terms mean. And that will require careful reading and repetition, and B, it will require some patience and diligence on your part. As I mentioned earlier in one of my announcements, that this is a new terminology, and obviously it will take a little bit of time to sort of really understand what these terms mean. But that is, understanding what these terms mean is really critical to your fully understanding the future concepts that we're going to be covering. Okay, finally, and this is the last thing that we'll cover in this presentation, we jump back to an exhibit in exhibit in Chapter 1, Exhibit 112, which I believe is very important. And this particular illustration is great because it shows both the balance sheet at the end of 2008 and 2009 and the relationships between the balance sheet and the other three statements, which are each for the period of time from June 1st through May 31st, 2009. This diagram shows the relationships between the four statements. So in analyzing this, what you want to do is track the red arrows. So we see the ending cash balance in 2008 is shown here in the cash statement, and the statement of cash flows then gives me the ending cash balance, which then goes to my balance sheet at the end of the period. Right. Notice that my beginning equity value comes down here. Net income, again, revenues less expenses, so the revenues that Nike earned through the sale of their products and goods and services, and less the associated expenses provided in net income, okay, of $1.48 billion. And so that income then comes down into the statement of stockholders' equity as income. The firm paid out some dividends and some other things going on in the equity statement, and we see an ending equity balance which comes back into the balance sheet over here. So notice these values are the same. So looking at this particular diagram, spend some time with it, but pay attention to the tracking of flows from the red arrows to try to really understand a little bit better the relationships between the four financial statements. Thank you for listening. I hope you found the presentation helpful.